Welcome to your online resources for Principles of Bookkeeping Controls. Here you've got a full suite of lectures which take you through your course notes, and you've got assignments and practice assessments to help you prepare for the big exam day. Principles of Bookkeeping Controls builds on the knowledge that you've learned in Introduction to Bookkeeping. So you look at reconciliations and checks to make sure that your data is correct. You look at redraft a trial balance, and you look at correcting journals for when your accounts perhaps aren't correct. If you're a bookkeeping student, this will be 50% of your overall grade. Whereas if you're doing the full certificate in accounting, this percentage that you'll get will be 25% of your overall grade.
Hello and welcome to the online lectures. My name's Stuart. Okay, now in this chapter here, we're going to be looking at just recapping some of the basic accounting knowledge. So really, there shouldn't be anything in this chapter that you don't already know, and it's all stuff that you should have seen before. So really, it's just a bit of a quick kind of whip through just to remind you of some of the key bits and some of the key things, okay? Starting off, first of all, with just some definitions. So, as I said, shouldn't be anything in here you're not familiar with, but it's just to make sure that if you've had a bit of a gap or a bit of a break in studies and stuff, you are familiar with these terms. So first of all, an asset. Well, remember, assets are just things that are owned by the business. That's essentially all they are. Okay, and so when we look at assets, okay, we kind of then tend to break them down, remember, into two categories. We've got our fixed or non-current assets, and we've got our current assets. Remember, the difference here is purely timing. Okay, so when I'm looking at a fixed asset, I'm basically looking at things that we expect the business to have for more than 1 year. So this is your kind of stuff like your buildings, your cars, things like that. Tables, chairs. If I'm buying an office building and a load of tables and chairs, I'm probably going to keep it for more than 1 year. Okay, so that's our kind of non-current assets. Current assets are the sort of things that we expect to have kind of for less than a year. So I'm looking here at things like items of stock or inventory, as we call it. To stock or inventory, depends whether you're using UK or international terms. Okay, that's the kind of thing. Look, if I've got a load of items in stock, I'm not expecting that to be there for a whole year. I mean, just think about all the products that Tesco have on their shelves. They're expecting to get rid of those within a year, okay? So stuff like that, things like your debtors or receivables, okay, that's the kind of thing we've got. So that's what we're looking at with assets, so should be familiar to you all. Liability, remember this is effectively the opposite, okay, this is something that now the business owes, okay, so we owe this to somebody else. So we're looking here that whereas we might have a bank account, if we've got money sitting in that bank account, it would be a current asset. If we're sitting and we've actually got an overdraft, it would then be a current liability, okay. And then other things we might owe, things like our trade creditors, okay, or trade payables, so the goods we buy on credit, that sort of stuff, bank loans, it's that kind of thing, okay. So asset, liability, okay, should be familiar with those. Now remember both of those, okay, as we will see. Statement of financial position, okay, so they are going to sit, remember, on our statement of financial position, okay, so SOFP, so statement of financial position, that's where those things would sit. Now we then have a couple of other phrases here. Income, okay, so income is essentially things like sales. I mean, you can have other types of income, but predominantly this is sales that you make. So as a business, okay, products you sell. So again, think about Tesco, all the items they have on their shelves. You know, as if you go and do your shopping there, as you leave that store and you pay for those items, Tesco are making a sale, okay? Now, you may see sales referred to as revenue or income or turnover. Revenue is the international term. Turnover tends to be more the UK term, okay? Now, there are other types of income, you know, for example, if Tesco have some money sitting in a bank account, okay, they might earn some interest, okay, on that money that's sat there. So that would also be income. It is still an inflow into the business, okay, but the other types of income tend to be much smaller compared to your sales. That's the real biggie in terms of what you've got. And then you have expenses, okay, so these are now your kind of costs that the business will start to incur. So, you know, purchases, wages and salaries, you know, rent and rates, okay, all that kind of stuff. That's the sort of thing we're looking at there. Now, remember, these things, these will sit on our profit and loss account, okay, so these sit in our P&L, okay, so we've got those. So income, expense, asset, liability, some big terms there. Now, just breaking it down a bit further, okay, did just mention these a minute ago, but again, just a reminder. So trade receivables, okay, is what we'd call them internationally. Debtors, they're often referred to in the UK. So this is where it's somebody who specifically owes money to the business. Normally, this will come when you make sales on credit, okay? So you allow a customer to take the goods, okay, and then say, look, pay for them at a later date. That is what we're looking at with a credit customer. And so in that interim period where they owe me the money, so they've had the goods, but they haven't yet paid for them, I would classify them as a trade receivable or debtor. Okay, now a trade payable, often referred to as a creditor, then the opposite, okay, this is somebody that we owe money to, okay, so this would be right now a supplier has given me some goods, so great, I've got the goods, I can use them in my business, but I haven't yet paid for them, okay, I've been told, look, pay for them in a month's time. Well, during that month when I've had the goods but I've not yet paid for them, okay, I have there a trade payable or creditor, okay, so trade receivable, trade payables, just a couple more phrases to be familiar with. Okay? So then, just distinction between capital and revenue expenditure and capital and revenue income. Okay, so again, just a bit of terms. So, capital expenditure, first of all, okay? This is where you spend money buying an asset, okay, and it's known as capital expenditure, sometimes even shortened to just CapEx, okay, so if you're ever at work and you hear someone referring to CapEx, they're talking about capital expenditure. So this is as a business, I go out and I buy a new machine, okay, or I buy a new motor vehicle, something like that, that is known as capital expenditure, okay, and so you're buying assets that are basically going to last for a long period of time. Revenue expenditure, okay, this is more spending money that's more short-term things, okay, and this is basically spending money on expenses rather than your assets, okay, so this would be me paying my staff salaries. That's known as revenue expenditure. I treat that as an expense, not as an asset, okay. This would be paying my electricity bill, okay, again, that would be revenue expenditure. So if we're buying assets, CapEx, okay, if we're basically paying for expenses, okay, it's revenue expenditure. Okay, so that's what we're looking at with capital revenue expenditure. If we then think about this in terms of income, very similar, just the other way round now, okay? So if we're talking about getting capital income, this is generating income by basically selling something that was capital expenditure originally, i.e. selling an asset, okay? So if I had a company car, it's 3 years old, I'm going to replace it with a new one, so I sell the old company car and buy a new one instead. Okay, well, the money I get from selling that old company car, that is capital income. Okay, so basically, if you're selling one of your sort of your kind of like your non-current assets, so to speak, okay, yeah, so something you treat as capital expenditure in the first place, okay, now you're selling it, that's capital income. Revenue income, okay, this is where you're just making you kind of really like your normal sales. Okay, so this is Tesco not selling an entire store. It's not Tesco selling a motor vehicle. This would be Tesco selling their normal products off the shelves. So, you know, bread and milk and, you know, cans of Coke, whatever it is. Okay, you know, that's the sort of stuff we've got in terms of revenue income. Okay, so fairly quick introduction there. I said there's nothing there you shouldn't be familiar with already. Okay, so it's just really a recap, just to make sure you're on track and you can remember terms that you have seen before, because we will use those terms throughout, well, not just this unit, but your studies in general. Okay, so make sure you are comfortable with all of those things. Hello and welcome back to the online lectures. My name's Stuart. So moving on now and looking at the accounting system. And so again, just thinking and really reminding ourselves of what happens and how transactions flow through the accounting system. Now, it's the kind of thing that the approach here is almost thinking about that in sort of ye olden times, how this would have worked on a very manual type system. And that's almost the explanation we give. These days, obviously, everything is computerized, and so all these steps happen literally at the press of a button, and they happen, you know, pretty much instantly. Obviously, when this was all done manually, it took a little bit longer. But it's just thinking, how do we take from a bunch of basic transactions, so, you know, a sale or a purchase or something, and ultimately, how does that end up producing a set of accounts, and how does it end up producing, you know, a sort of a statement of financial position or balance sheet, and a statement of profit and loss. So that's what we're really going and looking at here. Okay, so first of all, we have the basic transactions that actually generate some sort of source document. Okay, now predominantly what we're looking at here is invoices. Okay, so sales invoices, or indeed a purchase invoice. Okay, I apologise about my handwriting. I'm aware that when I write on the screen, it looks like I've done it with my feet. I do try. I'm just not very good at handwriting. I will do my best though. Okay, so we've got their sales and purchase invoices. So if I make a sale to somebody else, I will need to produce an invoice for that. Okay. Similarly, if I buy something from somebody else, I would expect to receive an invoice with that. Okay. So that is the basic transaction. So that is me, you know, supplying some goods to a customer. Okay. Or, you know, going out and buying some goods that I need. Okay. Now, what then happens is that those documents, okay, so things like the invoices, stuff like that, okay, you know, they get recorded in the books of prime entry. Okay, so it says there, sales invoices in the sales day books. Okay, yeah, and this is where we just have to be a little bit careful, because remember, if we're talking about credit sales, remember, there's the sorts of things that would go in the sales day book. Okay, remember, if it was a cash sale, I would put that straight in the cash book. Okay, yeah, so remember, the sales and indeed the purchase day books deal with credit items. Okay, the cash book dealt with cash items. Okay, yeah, but we record those transactions in the relevant books. Okay, so the main ones, sales day book and purchase day book for your credit sales, credit purchases, and then your cash book, which sometimes can get split, cash receipts and cash payments book, okay, for your cash items, okay, so things you're paying for immediately. Now, what we would then do is, you can imagine, if we were doing this in a manual system, okay, as I make a sale on credit, I'll just, you know, write it in this sales day book. If somebody comes in and pays for the goods immediately and I make a sale on cash, I'll write it in my cash book, okay? Now, what I will do at the end of the day is I will total up that book of prime entry, okay? And so I will just look at what are the total value of all the credit sales that I have made that day, or indeed if it was cash book, what's the total value of all the total cash receipts I've had come in that day, and I will just total that and get the total number. It is that total number that we do a debit and a credit on. Okay, now this is where, look, I accept these days in real life with computerized systems, they tend to post each individual transaction as a debit and a credit. Okay, but sometimes in exam land, they're still thinking a bit more like what you would have done with an old manual system, where you wouldn't do a debit and a credit on every single sales invoice. You would just total up the sales invoices at the end of each day and then just post that number as a total. Okay, so it's the totals of these books of prime entry we do a debit and a credit on. Okay, now what we then do remember is this general ledger, remember, sometimes referred to as a nominal ledger. Okay, this is where we collect the debits and the credits. Okay, so all the sales, okay, will go into a sales T account. Okay, and you hopefully remember your T accounts before. So all the sales would go into one account, all the purchase into another account, all the insurance into another account. Okay, and so that's where we collect those like items together. Okay, so we post the double entries into the general ledger or nominal ledger. And at the end of the period, we can balance off each account, so we can go, that's the total value of the sales, that's the total value of the insurance, whatever it might be. Okay. And then the final thing is that those balances on the general ledger, okay, they go into a trial balance to make sure we've not done anything wrong. Okay, and so our debits do equal our credits, as they should. Okay, and so we would do that. Now again, on a computerized system, that's not really a problem, because the computer won't post a debit without a credit. Okay, it just simply won't let you do it. You just get error messages all over the place if you try and do that. Okay, but again, if you imagine if you're doing this manually, you could very easily post a debit but not the credit, or post a debit and a credit of a slightly different number. Classic transposition error. You post 540 as a debit but 450 as a credit. Okay, so the trial balance just makes sure we've not done anything wrong. Okay, so that's our basic flow. Now look, just over the page, okay, we won't spend ages on this bit, because over the page it really just expands on what we were kind of talking about there, in terms of what you've got. So we were speaking about transactions. Well look, probably some of the main transactions you need to be able to deal with: making sales. Okay, so sales of goods and services. Whatever you do as a business, you should be able to deal with the sales. Purchase and expenses. Okay, so all the running costs of the business. You should be able to deal with transactions that involve you making a purchase or paying the expenses, and then also kind of making payments in and out of the bank account. Okay, so what we do with those things. So stuff you have seen before, should be familiar with that kind of thing. It then just starts to refer to the fact that the idea, as we already said, generally financial transactions will be accompanied by some sort of financial document. Invoices are by far and away the most common. Okay, so purchase and sales invoices, the most common. Things like a bank statement. Again, there will be a financial document you get from your bank. Okay, for those sorts of things. And then the other thing here, okay, just remember the difference between your cash and your credit transactions. Okay, so a cash transaction, remember, is one that basically happens immediately. Okay, so everything happens at once. So this is effectively like me doing my shopping in Tesco. Okay, so I go into Tesco, fill up my trolley. As I go to leave the store, okay, it's no good me just trying to walk out and shout to the manager and security guard, "All right, mate, stick that on my tab. I'll pay for it next week." That's not going to go down very well. Tesco obviously expects me to pay for that there and then. So that is a cash transaction. Now, whether I actually hand over physical cash and notes and coins, whether I pay for that on a debit card or a credit card, doesn't actually matter. It's a cash transaction. Okay, i.e., it happens immediately. Okay, so you are paying and you are transferring effectively like the funds. Okay, at the point you are acquiring the goods or services. Obviously, a credit transaction, okay, is different in that you acquire the goods and services, but you're not paying for them then and there and then. You are basically promising to pay for them at some later date, okay? And that's what we're looking at with a credit transaction. So, in general, in terms of what you get with this, if it's a cash transaction, you're looking at things like till receipts, till rolls, stuff like that. If it's a credit transaction, this is the sort of thing where you would normally expect to get an invoice for it. Okay, so that's just what we're looking at in terms of cash and credit transactions. But do remember, when we talk about a cash transaction, it doesn't necessarily mean that there will have been physical cash in the form of sort of notes and coins that have changed hands. It just means it's happening immediately. So as I said, paying for something on your debit card, contactless payment, we would count that as a cash transaction. Okay, so as I said, those transactions, that's what starts to get recorded into our books of prime entry. Okay, and that's the kind of thing we then just start to have a little bit of a look at as we move through this chapter. Okay. Hello and welcome to the online lectures. My name's Stuart. Okay, so what we're looking at here is moving on and just thinking about the books of prime entry. So again, recap of stuff we've seen before, okay, and just a reminder of what these books of prime entry actually are, okay. Now, there are some that you will see probably more regularly than others. Some of them are maybe slightly more obscure, but they are all books of prime entry, okay? Now, book of prime entry, what does this mean, okay? Well, if we think about prime kind of almost being like first, okay, it's the book of first entry. I.e., it's the first time we see a transaction in our accounting system. Okay, so that's the whole point with these books of prime entry. If we were going through and going back through all our books and our records, this is essentially the first time we would see something appearing within our books or within our accounting records. Okay, so book of prime entry there. So it's then just a case of really running through and just a reminder of what all these things are. So some are more obvious than others. Okay, so a cash receipts book to begin with. Well, as the name implies, this basically is going to list all the receipts, okay, coming in. Okay, now remember, we tend to use cash and bank as interchangeable terms, okay, and so really this is going to outline everything that's coming into your bank account. Okay, so all businesses have a bank account, so it's just your cash receipts book is everything that's coming in there. Now you then have your discounts allowed day book, a slightly less obvious one. Okay, so one that you're going to encounter far less regularly. I mean, you can imagine cash receipts book all the time because businesses are getting money coming into their bank account all the time. Discounts allowed book far less so. Okay. This is where, look, if I allow someone to have a discount for what we call a prompt payment. Okay, so if I say to someone, look, you owe me £100 and I'll give you 30 days credit. But if you pay me within 5 days, you only need to pay me £95. That's known as a prompt payment discount, i.e. you get a discount because you've paid earlier than you should do. Well, if we give someone a discount like that, we need to record the discount down, and so that goes into a discounts allowed day book. As I said, far less obvious and far less regularly you will counter those, okay, but it exists. One you will see all the time though is a cash payments book. Okay, well, if the cash receipts book was the receipts into the bank account, well, the cash payments book is now going to list all the payments out of the bank account. And so, cash receipts, cash payments, yeah, every business is doing that pretty much every single day where they've got money coming in and out of their account. So a dead common one, that one. Okay. Then the discounts received day book. So again, basically the opposite of our discounts allowed. So if discounts allowed was recording down all the prompt payment discounts I've given to my customers, the discounts received day book will be all the prompt payment discounts that I've had from suppliers. So if my supplier tells me, look, you owe me £100, pay me in 30 days, or you can pay me £95 if you pay me within 3 days, and I decide to do that, well, I'll need to record the discount I've received down. Okay, so again, probably don't see that one as much. So some others, we have the sales day book. Okay, so remember this is all sales on credit. Okay, and I cannot overstress that. Okay, it is only credit sales. Okay, that go into the sales day book. If I make a sale for cash, okay, by cash, or on a credit card, debit card, so for an immediate sale, then that will be recorded down in the cash receipts book. Okay, so sales day book is only the sales that you make on credit. It is not the sales you make on cash. And then the purchase day book is the opposite of that. It's now purchases that you make, again, on credit. Okay, if you have to pay for something and you make a payment in cash, that will go into your cash payments book. Okay, so these are your sales and purchases on credit. Okay, so just a chronological list of those things. So those two you would see regularly. Sales return day book. Okay, well look, sometimes when we send out some goods to our customers, for whatever reason the customer might send those goods back. Okay, whether they're faulty, or there was a mistake on the order, or we've just given them some goods and said, look, we could do what we call sale or return. It's like, we'll give you 30 days, sell what you can, anything you don't sell, send back to us. Okay, so effectively a sales return day book literally records down the return that we've had. So any goods that the customer sends back to us goes into that sales returns day book. As I'm sure you can imagine then, a purchase returns day book even is just the opposite of that. Okay, so this is where we record down any goods we have returned to our supplier. Okay, so again, for whatever reason we have to send the goods back. Okay, we're going to record purchase returns in that purchase returns day book. Okay. Depending on your business, that might be quite significant. Okay, you can imagine if you're an online retailer, selling clothes and stuff online, they regularly get sent back. I mean, if you buy clothes from pretty much any online store, there's normally a returns label that comes with it, and it's kind of, right, why are you sending it back? Too big, too small, don't like the style, faulty, and then you just tell them why you're sending it back. So some businesses do have quite a lot of returns, others far less so. So depending on the business that you're in, that book or those books may be used quite a lot, or maybe not that much. A journal book then, okay, so the idea with this, okay, is transactions that are not in any of the above, which is helpful, okay. So these are normally record down kind of accounting adjustments, okay? So things that don't get picked up via a transaction, where there is a distinct sale or purchase or invoice or bank payment, but we need to make an entry in order to make our accounts correct, okay? So we end up doing that via a journal. Something you may possibly have heard of or come across before is something called depreciation. So if I buy a car, that asset, well, I will depreciate the value of that asset in my books. Okay, start to reduce the value of that asset. Well, I don't think if you've bought a car, you know that your car falls in value the longer you own it. Okay, and that is depreciation. Well, you don't get an invoice for that. You don't make a bank transfer for that, but we do need to record it down. So that's where I would use a journal. Okay, it's where there is a valid entry that needs to be made, but I don't have invoice, bank payment receipt for it, that sort of thing. And then finally, last one here, the petty cash book. Okay, so this is where we are now dealing with genuine cash. Okay, so this is dealing with, like, notes and coins, and this is just very small cash transactions. Okay, so it's the kind of thing that increasingly this is becoming less and less and less common within businesses. But again, it used to be quite common that in a business you just have a small petty cash tin, whereby if you just need to buy some milk for people to have in teas and coffees, or some stamps or something, people would just take some money out the petty cash tin, pop to the local shop or to the post office, buy some stamps, buy some milk, okay, and we just pay for it out of a little bit of company cash, okay. So that we're dealing with our petty cash book. So again, should have seen all, if certainly most of those, if not all of those before. Okay, so again, just a reminder really of those key books of prime entry.